All right. Well, welcome everybody. We'll give people just a couple more seconds here to hop in as they come in right on time. Thank you all that got here promptly. As you guys know, these tend to last somewhere in the 30 to 45-minute range. We always want to make sure we leave some time at the end to answer any questions that may come up. If you do have questions, please go ahead and enter them into there's a Q&A box at the bottom of the screen. You can just click that and enter the question, and then we'll get to it at some point in the presentation here. And give us, like I said, just a few more seconds, and we'll get this thing kicked off. All right, let's go ahead and get started, Josh. Looks like we got a pretty good number in here. All right. All right, so thanks again, everyone, for joining us. For those of you that don't know me, my name is Kyle Kite. I am the CFO and an advisor here at Klaas Financial. And joining me today is Eric Schwartz, another one of our advisors out of our Madison office, and then Josh Stirling, who is our Director of Portfolio Management. So for those of you that have been joining us for a little while, we're the normal crew that you get on these things. So. All right, so I will go ahead and give you guys an update on some of our numbers. So this is at the bottom of our website for those of you that have checked it out. But we serve over 1,000 clients in 33 different states. As you guys know, I'm sure a lot of people don't tend to stay in this area for full time in retirement. So we do have clients that spread out all over the place. We've been in business for 48 years, which we're very, very happy about and excited for. We have 21 employees here. Like I said, two main locations in Loves Park, Illinois here, and then up in Madison, Wisconsin. And in this last quarter, we crossed over the 700 million in assets under management, which again is very exciting for us. So what we'll start with today is, go ahead, Josh. Oh, there it goes. All right. So as we know, we are within 30 days of an election. If you watch anything on the news, this is what we are very, very focused on as a nation, obviously. And like I said, within 30 days of the election. So we wanted to start today, kicking it over to Eric to let us know how the market has historically performed in election years and years after elections.
Thanks, Kyle. As Kyle mentioned, we are less than 3 weeks from the big day. And I think as an advisor here, Kyle, you'd probably agree as well. This is what we are spending a lot of time talking to clients about right now. This is on everybody's mind, and it is in our faces every single day. But I think we've talked about it a lot in the last couple of quarters of webinars, but just to kind of revisit it one more time before we move into election day. Markets historically don't react in a medium or long-term way to elections. So that's not to say we won't see some, volatility couple weeks before, a couple days before, and maybe a week or two after. But really, when we're saying like medium and long-term impacts, it's like if you think in your meetings with us, we're always looking at your performance over a long period of time, and you can kind of see the graph going up and down. And major events you can recognize on there, right? You can see when COVID hit and the market plummeted and then recovered, and you can see when interest rates spiked in 2022 and the market went down and then eventually came back up. When we're talking about not seeing medium and long-term impacts from an election, generally, it's when we're looking back at this, you probably won't be able to look at it and say, oh, that's where the election was. That was election day right there, right? Because the market is just much more concerned with economic trends, much more concerned with the latest inflation report, much more concerned with the latest jobs report, right? The election will have some level of noise, create some level of noise around what's going on, but largely the market is focused on other things. So just to give you kind of an idea here, we're looking at an 80-year time frame ending back in 2020. We're looking at the average return of the S&P 500 during an election year and after. So you can see just under 10% there during an election year on average, and then 11.7% the year after an election. For some context, the S&P 500 is up over 22% year to date. So again, these are average numbers, but really, we just wanted to come back to this because obviously it's really front of mind for everybody. And while we may be thinking about the election, and we may have all sorts of ads and things going on in front of us at all times, the market is less interested in it than we are.
I actually love this slide here because, like you said, over the past couple of quarters, we've been talking nonstop about the election, maybe too much. But every slide we show is slightly more complex. But there's something beautiful about like the simplicity of this. It's just, here's just a number that we can put up. It's highly positive. It's really good, and we've seen that reflected this year. If you have questions as you're coming into meetings, we actually have some of these slides that we've generated over the quarter refreshed, so we can actually pull it up in client meetings if you have any questions about that too.
And speaking of things the market is more worried about, perhaps than the election, I think we can all pop the champagne. Good times are back. I'm just kidding. But after more than a year since the Fed's last rate hike, we finally saw the Fed lower interest rates back in September. And not only did they lower rates, Josh, but they came out swinging with a 0.5 point rate cut. General consensus leading up to the meeting was we'd see a 0.25 point cut. Just seemed to make sense. The Fed's been very cautious through this whole process, but I think they surprised us a little bit coming out with a 0.5 point cut. And just as a reminder, the big thing with lowering interest rates is it makes the cost of borrowing lower, right? Businesses, citizens, people can borrow money at a lower rate. It encourages them to spend more. Because remember, rates began to rise. The Fed brought them up quickly in an effort to control inflation and to basically slow the economy down, right? And as we look at their other things that they're trying to balance, they're trying to bring inflation down, but they don't want to do too much and push us into a protracted recession, right? So that's why they're now responding with, okay, we feel like inflation is coming down. We feel like we're starting to get some kind of ominous reports about new hires, things like that. So let's take off the brake a little bit and sort of let things begin to expand again. And I think we'll see what they decide to do here. I think it's reasonable to expect we may see another cut before the end of the year, followed by continued rate cuts. I think the market's pricing a lot of that in. I do also think, I mean, as I've been reading kind of some of the transcripts from Fed meetings, I seem to see over and over again kind of this reminder that they don't expect us to go back to where things were for the 15 years post financial crisis, right? This idea of a 2.5% 30-year mortgage may not be in our near future here.
I thought it was really interesting because you talked about how the market was assuming that there was going to be a 0.25% rate cut coming into this meeting. And I mean, by all means, the Fed had illustrated that was what they were going to do. Yeah. In the meeting prior, Powell basically came out and said, don't even consider a 50-point cut. It's not going to happen. It's not going to be in the future. Hold. That is exactly what we got. And it's really interesting to see how tight-lipped the Fed was about that coming into it. Now, granted, we say that there was a large assumption that it was going to be a 0.25% cut. However, the market was kind of pricing it in leading up into the days. The numbers were just hitting right with inflation and all the data that was coming out. So it was interesting to see that play out and kind of a breath of fresh air to see the Fed come out and actually make that announcement.
Yeah, we were all talking about it leading up to the decision and, kind of like, oh, what do you think it's going to be? What do you think it's going to be? I thought it was going to be a 0.25 point, and I'll accept, I was wrong. Thought it was going to be a 0.25 point.
Yeah,
but
I was right there with you. And actually, we did just get a question. We typically wait for these to come in at the end, but I think this is a really good question to answer. The Fed, which is the Federal Reserve. It is a group of Federal Reserve. It's broken out across America. There's a lot of different Federal Reserve companies spread out across America, and they all have heads. There's one in New York, there's one in Chicago, and they represent different regions across America. And so they all work in those specialized regions to identify what's happening. They all come together on a 6-week rotation where they meet together and say, what action should we take to help the US economy stabilize, react to different things that are happening? They essentially have 2 things that they watch for. They watch for inflation, and they ensure that America has a good, stable workforce. And they look at that specifically by the unemployment rate. And so these are things that they watch for as an independent organization outside of the presidential departments. So they all meet up together. They all have their own terms, their own ways that they get appointed. And their goal is to make sure that the US economy has a long-term high quality growth opportunity. And they take action when action needs to be taken. And so we talk about them a lot because their job is quite important in the US economy. But it is a good question. It is a really large organization with many, many people across America. So really great question.
Yeah, and we always have Chair Powell on here. He is the chair of the Federal Reserve Board of Governors, and they're controlling what's called the Fed funds rate, which many financial institutions use to determine what rates they are either going to borrow money to consumers or businesses at, and also, what kind of interest they're going to pay for deposits as well.
And when the chairman changes, we will change it to the new. Yeah. And we really show this a lot because it's quite topical right now. So we focused on them a lot because it is very important in the economy currently. All right. So we'll move ahead here. Now, Eric talked a little bit about the reason why the Fed is kind of moving interest rates in response to inflation. And we've talked about inflation a lot here as well over the past couple of quarters, but we're going to look at it in a bit of a new light here today, comparing to something else that's very impactful to households. So on our screen right now, we're looking at a chart that shows wages versus inflation. And so the orange line on the screen is one that we've been looking at for a number of quarters. That is our normal inflation that we see in the US market. And we can see that over this time frame, 2020 to current day in 2024, we've seen inflation rise over 2022. And then start to come down late 2022 into 2023. We saw that it peaked around 9–10% back in 2022. But that orange line right there depicts what we experience in inflation over that time frame. And we can see over the past year or so, we've seen inflation start to settle down. We've seen things within inflation start to kind of come down, even though they were high for a long time frame. Housing, for instance, started to finally level off a bit. Back in January, it was around 6%, and now it's finally started to come down to about 4.8% roughly. We've seen core inflation, which strips out food and energy. We've seen that finally come down. Now it's hovering around 3.2%. These are numbers that are still high and still have room to move down, and we'll hopefully see inflation continue to decline. But we've seen the impact of the Fed's response, and we've seen inflation kind of stabilize and still come down at a slower pace. All things look like we're leading into kind of that soft landing environment, which would be incredibly hard to hit, but seems like we're heading in that direction. Now, the other piece on this graph that we're looking at, and that's the blue line that we see across the screen. That is looking at wage increases. This is technically called wage inflation, which is the increase in wages over time on an annualized basis. And we're comparing it directly to inflation. And we can see here that in this short time frame, that wages have not been above inflation for a number of years. And that is because it is typically slower to react compared to what is happening in the inflation environment. During 2021 and into 2022, as we saw inflation really start to pick up, wages kind of responded, and they did jump up a little bit. They jumped up to about 5-6%. We see that happening in 2022 and even in 2023, but they never increased all the way up to 9 or 10%. And this can be really painful because while we're seeing inflation jump all the way up near to double digits, it feels like the dollar's not getting stretched as far. It feels like expenses are going out of control and my paycheck just isn't going as far. And these are real struggles that we experience for a number of years. The benefit that we get in the long run, and I wouldn't even say it's a benefit, but the reality that we experience in the long run is eventually wages are going to respond to it. Not in the magnitude that we saw, but we will see it respond over a long enough time period. And that's what we've seen over the past year or so. Wages have finally started to outpace inflation. And it might not feel like it because expenses increased much faster compared to what happened to wages. But we finally started seeing that response happen. And this can happen from so many different things. One, individuals are finally getting wage increases from the reality of inflation. People might be moving jobs. We just have general growth in the economy that's causing wages to increase over time. And this response can hopefully help that dollar stretch a little bit further over a long enough time period. Now, we can look back beyond just the past couple of years to see this actually play out. So we're looking at just the past 15 years, but even over just the past 15 years, we can see that average wages, and these are the dotted lines, both in blue and in orange, we can see that 15-year average wages does outpace the 15-year average inflation, just by a little bit, but enough to help pace out average inflation over a long enough time period. Now, I'll pause here because not every individual is in the workforce. Not every individual is getting a paycheck on a salary. We have clients that are still working, still in the workforce, receiving paychecks, but we have a lot of clients that are in retirement, are waiting on Social Security, or are receiving Social Security. And you might be asking, well, how does that look on that side of things? So let's take a look at that. So this chart, on the other hand, is looking at inflation from 2008 all the way to current day. But we're adding in another element here. So we're adding in something called Social Security COLA. COLA stands for Cost of Living Adjustments, and that's represented by the green bars across the screen. Now, Social Security receives increases compared to inflation, but differently than wages. Wages are a natural response, take time to come into play, make impact from different things that are fluctuating in the market. They tend to be a little bit more live in real world, responding to the real life environments. Social Security does respond to inflation, but it only responds once a year. And it uses data that's collected by inflation. And we can see here that just a really interesting impact on this graph here. You can see inflation rise in different time periods, and you can see just a little bit after those peaks in the graphs that Social Security is adjusted in response to kind of that near peak time frame. It's a really interesting element. And it's nice to see this kind of laid out in this way, where you can see that Social Security does respond to inflationary environments, but it is delayed. Now, there is one interesting element on this graph here. It looks like there's missing data. You look at this graph and it looks like there's missing green bars in some spots, specifically in 2010, 2011, and 2016. But that's not missing data. That is actually where Social Security decided not to raise the COLA payments. And they did this because we can see back in 2009, inflation went negative for a small period of time. And essentially, instead of going back and having Social Security reduce everybody's payments, which I promise would not be received very well, we see that Social Security simply just elected to skip a year or two to wait for inflation to come back to more normal numbers before going back to increasing payments every year. It's an interesting element. We actually look back, and Social Security has never reduced payments in their history. Not saying that they won't, but it's interesting to see the ways that they use their tools to increase payments or at least take a pause on those payments. The payment that we see in November or 2024 or October was actually just released. That number just came out, I think, a week ago. And so we're seeing that respond to the recent inflationary environment that we went through. I believe it was about 2.6 or 2.7.
2.5.
Yeah, thank you. But we had already received a pretty substantial price increase the year before that. So we wanted to kind of address inflation and the ways that income is adjusted for inflation over time. Social Security and wages are similar, that they at least respond to inflation, but they're different in that they take different amount of times and they're influenced by different things in the environment, by the way that they actually react to inflationary environments.
Right, because Social Security is generally indexed to the Consumer Price Index. So there's an annual scheduled adjustment, whereas with wages, it's more a result of competition in the market, right? If employers feel as though there's risk that their employees may go somewhere else if they don't pay them more, that's a time where you'll see an adjustment. General kind of expansion in the economy, companies are more willing to give pay increases when things are going well. So they're not scheduled, right? They're a result of other things going on in the world.
All right. Well, the market's been really good. So Kyle, what's been happening so far this year?
Yeah, we'll switch gears a little bit here, guys. So as we mentioned, the S&P is up over 20% so far year to date. We've been kind of talking about it throughout the year on these conference calls, obviously. And you've heard us kind of set the stage that historically the late summer, early fall can be some of the most volatile times of the year. And actually the only 2 months that have September is the only month that has a negative average annual return out of the whole year. So it's not uncommon for September to be a bad month. But in this year that we've just experienced, it was actually a historically good month for the month of September. So you can see just in the month of September, it was up just over 2%, which is really, really strong for going into the end of a quarter and things like that. So like I said, it's been a good year overall, but we really seen a spike up here just in the last month. In October, obviously, historically is the most volatile month. Doesn't mean good or bad. It just means volatility. And then as we mentioned a few slides back, when you add on the election coming up and the headlines that'll come out of that, we would not be surprised if there's a little bit added volatility over non-election years in this October. But again, doesn't mean good or bad. It just means we tend to see more swings day to day, week to week in this month here. So
I don't think any of us could have predicted what was going to happen this year. If you would have asked me back in August what's going to happen in September, I would have said it's going to hit the annual trend of going negative for sure. It's an anomaly, the performance that it had this year. Might actually ruin the historical data a bit.
All right. And on another side of this is that bonds are back in balance. So you heard us again mention this earlier with bonds are actually paying decent interest rates now. So obviously we go back to 2022 because that was the worst year for bonds that we've ever seen in this lifetime, but it does take some time for them to kind of claw their way out of it. The bonds get price appreciation is one side of it, but then also interest payments are the other side of it. So interest payments have been in that 4 to 5% range, just depending on what kind of bond you're looking at and things like that. So you're getting better interest for your bonds. And then also when interest rates reduce, that tends to drive existing bond prices higher. So we're really set up for a really decent outlook for bonds going forward, which is what the market has priced in. So you see really the second half of this year, the bond prices, which is what this is showing, that blue line is actually up pretty substantially. This does not factor in the interest rate payments that they're making either. This is just price appreciation at this point, right? So they've continued to do very well the second half of this year. But again, like I said, the market is actually kind of pricing in more rate cuts, which could, in fact, some of this is already priced into why it's doing a little bit better this year. But then on this slide, we also have the stock market. So as we talked about, it's up 20-something% this year, but you'll notice we've had multiple downturns within this year. So again, this isn't, we always joke that we wish we could just make it go up and to the right and give everybody 5% a year guarantee. But unfortunately, that's not how this works. You're going to have good months, you're going to have bad months, you're going to have good years, you're going to have bad years. So what is interesting to see, though, when you put the 60-40, which is that orange line in between the green and the blue there, what you'll notice is that when the market is having its little downturns like it had just back in the end of July, first part of August there, the market had a pretty sharp downturn, but you'll notice the 60-40 didn't go down as severe, and that's due to the bond price appreciation and those being a buoy. So what we're explaining here is that bonds now, like I said, 2022 was a really bad year for bonds, but now that interest rates are higher on bonds and them likely being cut, you're going to see bonds act how we would expect them to over how they've acted historically. So they're a more normal relationship now between stocks and bonds than we had prior to all these interest rate raises and things like that over the last couple of years. So it's the 60-40 portfolio. We've been saying this for the last 2 years, basically is set up very well going forward. And this is just more validation that it is a really good blend for where we want a lot of our clients to be at this point.
All right. So with discussion of, the Fed finally starting to reduce rates, I think it's sort of bringing the concern about recession back into the conversation. So as I was talking about earlier, the Fed has sort of two mandates, right? Or not mandates, but two goals. They're trying to control inflation, but also make sure that they don't put too much pressure on the economy and force us into a protracted recession. And we were kind of getting ready for the webinar this time around, and there's a lot of signals or triggers of a recession that people generally look at. In general, we don't know if that we're in a recession until we're out of it, right? And we're looking back on it. But we thought we'd kind of look at, okay, what of the, call it 10 or 11 recession signals have we actually experienced? And really, the Fed is continuing to talk about their goal of a soft landing, and surprisingly, it still does appear to be a possibility. But let's talk about kind of what we've experienced in terms of signs of a recession. So the first one you can see on the slide here is an inverted yield curve. So this is something we've been living with for quite some time now, right? It's the idea that you're able to earn more interest by lending money over shorter periods of time than you are over longer periods of time, right? So this has been, we were talking about this earlier, just back in September, we started to get some hints that maybe things were working towards normalization where, long-term interest rates are higher than short-term. But this is something that I don't know that we can even call it a signal of a recession because we've been experiencing it for so long. The other two here that we wanted to highlight, the next one would be home price appreciation. This is another one that it's hard to say, home prices are now going up, so that means we're headed for a recession. Home prices have been going up for a very long time here, largely in response to the fact that we don't have enough housing supply, right? But as we look at sort of the historical definitions of what's going to cause a recession, what is a recession, and then we put them into context of kind of the world right now, it's hard to say, well, that's definitely a signal that we're headed for a recession. The last one we wanted to highlight here is an unemployment uptick. And it's kind of funny because I think we had about 1 or 2 months where unemployment started to tick up, and then we'll get another report saying it's, the job market remains really, really strong. Mm-hmm. So as we look at these, I don't know. It's hard to say that any of these are a signal that, things aren't going well and the Fed isn't doing.
And I think a really important takeaway from talking about recessions and talking about triggers is these are all typically headlines. You're not having the Fed come out saying, we're hitting 3 of the 11 recession indicators. So therefore, no, these typically are news bits. These are typically researchers who are trying to find answers to what's going to happen. Every single one of these comes with a caveat of, these triggers may not work in future environments. And the reason is because if you look back across history, recessions are caused from different things. Back in 2008, it was a housing crisis that occurred. So you have all these things that can cause different elements of recessions. Not one indicator is going to be a perfect correlation with what's going to happen in the future. So like Eric said, we have to look at these in context because they may have worked in the past, but are they going to work in the future? Well, maybe not. Unemployment, to your point, it upticked to a certain point that had a couple of headlines put out, and then the very next reading it ticked down, which historically has never happened before. So are we headed towards a recession? Nobody knows the answer, but I would just say temper expectations with what you're seeing in the headlines if you continue to see this kind of commentary in the market. And we'll definitely address it in the next quarterly meeting.
The other thing I would add here that I think is just kind of interesting is there is a lot of value to what we as a society learn over time as it relates to financial, I don't want to say crises, but financial events, right? I mean, if you think just for example, historically, if we were running into financial headwinds, the Fed didn't know exactly what they were going to do, right? Like now, when the economy slows down, they lower interest rates, right? They encourage spending. That hasn't always been the approach that we've taken, right? We didn't understand the way all of these levers we have to pull as it relates to the economy, how they would impact things. So we've learned a lot over time, especially when you look at financial crises of the past. So as much as we don't always feel like we're learning things, we are, and we're learning to handle these issues a lot better, I think, as well. But it's my job at the end of all of these webinars to remind everybody that recession, no recession, our focus always here is going to be on making sure that no matter what's going on in the market, in the economy, that we are focused on helping all of you retire and draw money from your portfolio, live the life you want, regardless of what's going on. Okay, so we build your retirement plans with the expectation that there will be times when the market is not doing well, when the economy, we're in less than ideal economic conditions. We expect that because we can't sit across the table from all of you and say, congratulations, you're in great shape to retire. And then there's a caveat of, well, as long as the market keeps going up, yeah, you can retire. We build in a lot of leeway, a lot of cushion to make sure that when we actually tell you, yeah, now's the time, right? You're ready to weather these things. So really what we want to communicate to you and what is the most important at times like these is that we are sticking to the plan that we built, because as we've seen over time, it works. So just want to pull us back to that again, as always.
All right, perfect. Well, we did have a couple of questions pop in, so we'll go ahead and we'll open up the Q&A here. We have a couple that popped in already, but if you have any questions that you want to ask, feel free to go ahead and use that Q&A button at the bottom and submit those in. So the first question that we have here is actually really interesting. So since the Fed lowered rates, mortgage rates haven't seemed to drop. And over the last week, it looks like they're increasing. Why? And I think that this is a fantastic question because it gets into the funky world of bonds, how bonds work, loans, interest rates, and market expectations.
I love how much that made you smile.
So the reality is that mortgages are on 15, 20, 30-year loans that are really long dated. What the Fed is controlling short-term interest rates to influence the market, spending, all these different factors that they're hoping has a result on what's happening in the current economic situation. The mortgage rates are influenced by the Fed, of course, but a lot of other things. One of the biggest things that's impacted is how long we have until that mortgage is finally paid off. let's imagine a 30-year mortgage. When a bank goes out and they say, what interest rate should we choose? Well, of course, they're looking at current rates that are out on the market, but they're also thinking, well, what's going to happen over the next 30 years? Where do I think interest rates are going to change over those 30 years? And so if we sat here and we said, well, interest rates are probably going to be 20% in 30 years, that mortgage might be way too high for market expectations. And so currently we're in this odd environment where nobody really knows exactly where the Fed might eventually end up at a normalized interest rate over a long time period. And so you see the market kind of guessing here and there. Well, we think that the Fed during the next meeting is going to say this thing, and that's going to mean that they're going to hit like 3% over the next 5 or 10 years. And so the prices on a 30-year mortgage is going to go up or down slightly depending on what they say. And so before the last Fed announcement, there was a little bit of understanding that, oh, okay, we think that the Fed's going to come in and they're going to say, oh, we've got 3 more cuts this year, we'll have a few more the next year, and we think that we're going to end up at this rate. And so you saw these 30-year mortgage rates start ticking down a little bit. I think at one point they actually dipped below 6% as the national average. And then as the narrative changed a little bit and, oh, you know what, we might actually have higher rates for a little bit longer, depending on how the economic situation plays out. Well, then you see a little bit of a reversal of banks pricing in what those mortgage rates should be based on the current picture of what the next 5, 10 to 30 years could look like. So I wish I could say that it's just a perfect math equation, but it's a little bit of that, a little bit of what the economy might look like, what it can handle, and what the market is feeling is going to happen over a longer time period.
And I think it's important to know too that we've been in like artificially low interest rates for a very long time. So people are we have this misconception that 3% is normal, whereas the Fed funds rate right now, and as Josh is explaining this, the Fed funds rate is just what banks can borrow money from for an overnight cycle. That's what the Fed controls. It doesn't control, as Josh said, mortgage rates and all that kind of stuff. But the Fed funds rate right now is somewhere around 4.8, but the long-term historical average is more like 4.6. So it's honestly not way out of line. It's just a lot different than what we're used to seeing because of the last, 15 or 20 years of interest rates that we've been in here. So.
Yeah, and I think the other thing that that we'll probably see in shorter order is changes to shorter term debt. So credit card interest rates, home equity lines of credit, eventually, auto loans, right? These are shorter term debts that also tend to be sort of directly indexed to some level of, or some in debt index. So for example, I know my bank just sent out an email to all of its customers today saying, starting November 1st, we're adjusting home equity loan interest rates based on the fact that the Fed just lowered rates by, half a point. So it's not also as if the day that the Fed makes the announcement, the bank says, great, let us drop the interest rate we're charging you. So some of these things just take a little time to kind of work their way through.
Absolutely. All right. I like this question. I think this question was put in before we talked about the Social Security side of this, but we had a question. If I am no longer working and don't have a wage, how can I handle inflation? Are there spending habits or investment choices I should be adjusting during periods of high inflation? And so I'll leave a portion of this to the advisors on the call to kind of talk about, there's a bit of a difference between what you should academically do and then what people actually do. But the one thing that I want to address that we didn't address in the Social Security discussion, how Social Security has cost of living adjustments, is inside your portfolio, what happens there. And so during higher inflationary environments, that's why we still have clients invested in equities inside a portfolio. Is it a perfect correlation to the way that inflation moves? No, but over a long enough time period, we see equities outpacing inflation by a substantial amount. And so it's why we encourage individuals to still have equity exposure even if you might not want to have that level of risk, at least taking on some level of risk in the equity markets, especially if you're retiring at 65, have a life expectancy to 90, 95, even over 100. Having that equity exposure is quite important to help maintain a portfolio in higher inflationary environments. But I think the practical experience from advisors might resonate a bit nicer here.
Yeah, Kyle, I'll let you weigh in on this in a second too. I think what the question is getting at here, like, are there spending habits? You just discussed investment choices, but are there spending habits that I should adjust during periods of high inflation? I think from our perspective, from a planning perspective, we're building retirement plans and income plans based on a certain level of spending. Generally, those aren't hard, fast numbers. We're not telling people you can retire today so long as you never spend a penny over this assumed annual spending. We build in like I was saying, we build in cushion, we build in the expectation that there's going to be times when you spend more than we expected. There's going to be times when you spend less than we expect. Periods of high inflation tend to be just that, periods. They're not permanently higher. It's not as if suddenly we're expecting a 3% inflation rate on average and it's suddenly an average of 8, right? It'll rise to that during short time periods. But from my perspective, I would say that assuming we're not in a protracted 5 or 10-year time of high inflation, that our clients shouldn't need to be drastically, changing the way that they're living their lives because we built them a plan that's so close to the line that they have to reduce their spending with inflation.
Correct me if I'm wrong. I don't think I've ever had an advisor say, "Oh, I just had my client call in for their annual 3% rate increase." That generally, I don't think happens.
Yeah, that's exactly what I was going to say, Josh. It's just because you get used to your lifestyle, right, and it usually stays fairly steady as you move out through retirement. But you're right, we don't get a call on, "Oh, it's January 1st, Kyle. You need to increase my income by 3% because that's the historical average of inflation." Now, we will go years without touching that, but then you'll have a year where, like we just went through, where it went up 9%, and now groceries are more expensive, so people need to increase their distributions a little bit. But that's going to be a one-time or a very rare thing where it's an ongoing thing where every single year we're ratcheting it up just to make up for inflation. So,
it's a great question. All right, so we have a couple of other questions here. So I think this one, we're not going to have perfect answers for these, but we can at least chat about them here briefly. But do you think economic trade tariffs fuel inflation? So Eric and Kyle, do you have any thoughts on this? Because I think it's kind of a mixed bag. And we've seen it happen in the past. From an academic standpoint, yes, you can see that tariffs should be passed off to consumers. In the real world, what we've seen historically, it can be a little hit or miss. Some is passed off to consumers through kind of this inflationary aspect as prices increase on what it takes to distribute product to America happens. Well, is that just going to eat into profit margins, or is that going to get increased in prices to consumers? And it can be a bit of a hybrid, a bit of both. So I'd say in a perfect world, we'd have a perfect answer, but like most things, it really depends. Could it? Yes. But it could also be mitigated by other aspects. There's a lot to that to deconstruct.
Yeah, I think it's like you said, it's two pieces, academically and then in reality. I think from a business's standpoint, a business's job, a corporation's job, is to make as much money as possible for the shareholders of that corporation. That is the mandate given to leadership. So generally, if they have higher costs, they are often going to pass those on to consumers, provided consumers are willing to pay them, right? So that's the way the free market works, right? The consumer will tell the producer how much they're willing to pay, and generally that is the amount that they will charge. So I think I'm speaking of this very academically, and I think this is probably potentially a political question more than anything, but academically, you would expect, yes, that it would be by definition inflationary.
All right. And then does the market doubt that that if a deportation of millions of migrants, how would that essentially impact U.S. economy? Specifically, it's called out here, the Wisconsin dairy industry. But again, I don't think that we would have a perfect answer for this. But the reality is that there would be some impact in that instance, but there's also a reality of how does this actually play out? So I don't think that there's one perfect answer to this, unfortunately. But
I would say, I mean, I think the question is, does the market doubt or how does the market feel about this?
Mm-hmm.
I can't say for sure. I don't know that the market is thinking really deeply about this at this point in time. I think this is sort of one of those areas where perhaps the political world and the economic world maybe diverge. Not to say that there won't be an impact, because potentially there could be. I think just the way the question's asked of, does the market doubt this? I don't know that the market's thinking a lot about it.
Mm-hmm. All right, perfect. Well, thank you very much, everybody, for joining us. We appreciate everybody jumping on and spending time with us. We'll be back after the election, actually in the new year. So wow, got a lot coming up here over the next couple of months. So a lot to look forward to in our annual discussion. Thank you, everybody, for joining us today.
Thanks, guys.
Bye-bye.